Hello, everybody. This is Dr. Richard Smith, and you are watching Cycles TV, brought to you by the Foundation for the Study of Cycles. And very proud of what we continue to deliver to you here on Cycles TV and from the Foundation for the Study of Cycles in general. We are a not-for-profit, and your support and your membership is what makes this all possible. So thank you for that. And look forward to digging into what's going on in our world today with you over the next little bit. So today I'm going to do something completely different. I'm not even going to be talking about cycle analysis, foundation style very much, but as the chairman and executive director of the Foundation for the Study of Cycles, I think a lot about why does the foundation exist? What do we need to be doing? And I can say confidently that one of the reasons that the foundation exists is to avoid the next depression. Okay. The foundation started after Dewey was the chief economist in the Hoover administration, tasked with trying to figure out what caused the stock market crash of 1929 and the Great Depression. And why did he do that? Was it just an intellectual exercise, just a curiosity? No, he wanted to make sure this didn't happen again. And friends, I don't know about you, but I am concerned. I'm worried. I think we are at the point where something like that could happen again. And I think it's our job at the foundation and our job as citizens to do our best to try to understand what's going on, try to bring a knowledge of cycles to bear on the situation, and try to avoid the worst case scenario. So that's what I'm going to do today. I'm going to get into that conversation. Obviously, you're not going to answer that question in a short period of time, but it was triggered by watching. Well, it's triggered by everything that's going on, right? It's unsettling times, but it was triggered in particular by watching an interview of Ray Dalio by Tucker Carlson. I'll show that interview briefly, at least where you can find it. And Dalio was talking about his global debt cycles and the need to get the deficit today, federal deficit of the US government, down from 7.5% of GDP down to 3% of GDP. And I think that's a good goal. It's a good way to think about the problems that are going on in our world today. And I know we all want to time the markets and make sure that, our butts are covered, but there's a bigger thing going on here. And that is what's going on in the world, what's going on in the US economy as the economic leader of the world. And how do we make sure, again, that we don't have to live through the worst case scenario? How do we take that all into consideration? So with that as preamble, I'm going to show you just today, how I worked with ChatGPT to dig into what Dalio was saying in that conversation, in that interview with Tucker, see what we can learn from that, see what framework we can elicit from that, and if it can help us as cycle analysts to help ourselves and help others through the Foundation for the Study of Cycles. All right, so with that as preamble, and you guys, tell me as we're going along here, if what you think, what your questions are. Okay, so this was the interview. It's on YouTube. This link was from the Economic Times. Ray Dalio forewarns Trump, cut debt now or face economic heart attack. And he was being interviewed by Tucker Carlson. And it's a really good interview. It's 18 minutes long. And I recommend it. So what I did then was I took the transcript over here. You can go into the extra detail here and show transcript. Went up here. I removed the timestamps. You can turn those on and off, right? And then I just copied all this text. And I went into ChatGPT and I said, this is an auto-generated transcript of an interview by Tucker Carlson of Ray Dalio on the global debt crisis. Please turn it into paragraphs and sentences and identify the speakers, blah, blah, blah. So I gave it the whole transcript right out of YouTube, just like that, okay? And it actually took that and put it into not a verbatim transcript, okay? But a pretty good summary of the questions and the talking points from that interview. I was impressed. So we're going to go through that summary now and try to understand Dalio's main points about where we're at and what are some things that can be done today. So I'm going to move over to Microsoft Word here, where I just kind of broke this up to make it easier for us to kind of go through step by step. So Tucker says, Ray Dalio, thank you for doing this. You've run the biggest hedge fund in the world for a long time. And in order to do that, you've had to think about the rest of the world in a systematic way. In doing that, you've developed a framework for understanding what's happening now and what's going to happen. I'm wondering if you could set the stage with that. What are the 5 trends you look at to think about the future? Great question. Here's Dalio's summarized response. This is not a verbatim response. As a global macro investor for 50 years, I found that sometimes I was surprised by things that hadn't happened in my lifetime before. So I had to go back and study history, and that helped me a lot. There are 5 major forces that operate in big cycles, and those together define the environment we are living in now. Okay. There's the money and debt cycle. Number 1. We now have a major debt issue globally. This financial force is crucial because debt is money and money is debt. We'll get back to that. It's important. But very important that he is calling out these cycles that the foundation has been talking about for 80 years as well, before Dalio was talking about them. But he's doing a great job of bringing an awareness of cycles to the world, and we appreciate it very much. Internal order and disorder. This force drives internal cycles where gaps between political factions grow, leading to populism and social unrest. I believe we are in a form of civil war now within various countries, and certainly within the social media verse, let's say. So that's an important cycle. The great power conflict. When a dominant world power is challenged by a rising power, you get conflicts like the one between the US and China. Acts of nature, droughts, floods, and pandemics have historically killed more people and toppled more governments than wars. Climate-related issues now play a major role. Technological innovation, human inventiveness, particularly in technology, is a significant force shaping the world. Okay, those are 5 great cycle topics. Love it. Everything we're discussing today falls under one of these 5 forces, and they move in a largely cyclical way. Tucker, you just laid out the basis for the world's most interesting 6-hour conversation, but since we only have 17 minutes, let's talk about debt. Feels like we're at the tail end of a cycle or the beginning of a new one, the famous 80-year cycle, right? Dalio doesn't really ever say this is an 80-year cycle, but Tucker said 80-year cycle, and Dalio says, yes, this is a pivotal moment. Tucker, if we start with debt, can you give us a sense of the scale of global debt right now? Dalio, it's unprecedented in all of history. All of history. That's sobering. Let me explain how the big debt cycle works. Think of credit as a circulatory system. Credit brings buying power and supports financial assets, goods, and services. But as debt accumulates, it starts to squeeze out spending. So he actually, in the more detailed comments, he talks about the circulatory system of the body and the heart in particular, and the buildup of debt in the arteries of the economy as being like the building up of plaque in our arteries. And it's a great analogy, okay? And as debt accumulates, it starts to squeeze out spending, right? If your arteries that the wealth is flowing through the arteries of the economy, the spending is flowing through the arteries of the economy. If those arteries are clogged by debt, not as much spending gets through. So I thought that was a fantastic analogy, a great way to think about it. For example, in the US, about $1 trillion a year now goes to just pay interest on our debt. And over the next year, we have $9 trillion in debt that needs to be paid back or rolled over. As interest rates rise, that number gets bigger and bigger, right? So it's a catch-22 that we're in right now. How do we keep interest rates down, while at the same time, there's this risk going on that we don't, if the interest rates keep going up, the interest we're paying on our debt keeps going up. We can't service the debt. We all know how that story ends. There's a supply-demand issue with debt. One person's debt is another person's asset. Okay. We live in the fully credit-based economy today. It's all credit-based. Money is literally like a bank making a loan, issuing debt. That money, if I go borrow money from a bank, I get money, right? But the bank is holding debt. So my money is the bank's debt. And it's an asset to the bank. And if the bank doesn't think I can pay it back, right, it's going to try to sell that at a discount. So it gets to be a vicious circle. When that happens, interest rates rise. As interest rates rise, asset prices can decline, and this triggers financial instability. The central bank then faces a choice. Let interest rates rise, which hurts the economy, or print money to buy the debt. But printing money leads to monetary inflation. Right now, we are in that situation. When I calculate supply and demand for debt over the next 1 to 3 years, we have an immediate issue. Immediate. I agree. Can you be more specific? What does that issue look like if it's not addressed in the next 3 years? Dalio. If not addressed, debt holders and buyers won't buy enough to meet supply. That means interest rates rise. Rising interest rates hurt the economy and asset prices, many of which are already expensive, decline. At that point, the central bank is forced to decide, do they print money or buy the debt? If they do, the currency depreciates. You get monetary inflation if they print money. That affects everything because the US Treasury market is the backbone of the global financial system. A problem there triggers a problem in all markets. When money no longer holds its value as a store of wealth, people start selling off assets. That creates a self-reinforcing cycle of selling, rising interest rates, and economic contraction. And that is what we have to avoid. Okay, it's not inevitable. It's hard, but we do have to avoid this. We do not want a self-reinforcing cycle of selling, rising interest rates, and economic contraction. So the US government is running a deficit of about 7.5% of GDP. If Trump's tax cuts continue, you expect that number to remain high. You're saying the deficit needs to be cut to 3% of GDP to avoid crisis. Right? The idea of tax cuts, that is actually lowering the ability of the US government to pay to service the debt. Okay, so that's not going to lower GDP by the deficit to 3% of GDP by itself, right? It might stimulate growth. That's the hope. But tax cuts by themselves, don't solve the problem. They exacerbate the problem. Dalio, exactly. Every policymaker and the president should pledge to get the deficit to 3% of GDP. Otherwise, we are likely to have a serious problem. Excuse me. Tucker, but that's a tight timeline. I think most Americans assume this is a problem for the distant future. You're saying it's imminent. Sorry. Ray Dalio. Based on my calculations, we have about 3 years to adjust. You need to make spending cuts now while the economy is still relatively strong. Otherwise, the debt keeps growing and the adjustment becomes far more painful. It's like going to a doctor. If I tell you, Tucker, you have plaque buildup in your arteries, you don't wait for the heart attack to happen before you start making changes. You need to address it now while you're still healthy. Well, questionable how healthy the patient of the US economy is today, but it's not going to get any healthier, as the days go by. Tucker, but when governments make drastic spending cuts, because spending cuts is one way to lower the deficit, right? They risk political instability. Yeah. People expect the government to provide certain services. When those services disappear, you get unrest, sometimes even violence. Are you more concerned about the debt crisis or the potential political blowback from fixing it? Dalio, both are serious risks, but at this stage, the bigger risk is not acting fast enough. You must take action and make adjustments while things are still manageable. There are 3 main levers. Taxes, not necessarily raising tax rates, but increasing revenue through economic growth. So raising taxes is one way to lower the deficit. But can we also increase tax income, right, through economic growth? That's the theory of cutting taxes, stimulating growth, tax rates, right? Stimulating growth, ultimately generating more economic activity and more tax revenue. The tariffs idea is another way of getting income to offset the deficit. Spending cuts, reducing wasteful spending, but ensuring it's done in a tolerable way. And interest rates, managing supply and demand so interest rates don't spiral out of control, right? I think $1 trillion of our $1.8 trillion deficit is interest on the debt. So if the 10-year yield keeps going up, that payment on the debt keeps going up and makes the deficit bigger. So Treasury Secretary Bessent has come out and said, our target is the 10% yield, or the yield on the 10% Treasury. We want to see that come down. We know that's hard, right? James Carville famously said he wanted to be reincarnated as the bond market because it can intimidate anyone. So they're right. Bessent is right. Trump is right that we do need those rates to come down, but it's hard. And as cycle analysts, I have basically one chart to show us today, which is this long-term 85-year cycle in 10-year yields dating back to 1787, right? And Dalio is talking about an 80 plus 75 to 100 year debt cycle. Okay, here it is. So, these dates are a little bit off. That was like January of 23, when we were at 3.22%. Bottom line, this cycle, is headed up. So we've got a very powerful cycle that is tending towards higher rates. Okay, it doesn't have to be 16% on the 10-year yield like it was in 1980. Okay, at the peak of the cycle back before the Civil War, it was about little above 6%. Okay, so it doesn't have to be this, but we've clearly got headwinds against lower rates, tailwinds for higher rates on the 10-year yield. So this is not going to be an easy fight to bring interest rates, keep them under control, keep supply and demand in the biggest financial market in the world, okay, under control. None of us should want to see the 10-year yields above 5 or 6%. That's going to be big trouble. So Dalio then goes on to say that between 1992 and 1998, the U.S. successfully tightened fiscal policy by about 4 to 5% of GDP without causing a major crisis. It's possible to do this again if we move quickly. Interesting. Tucker. Some argue that today's debt crisis is a direct result of artificially low rates after the 2008 financial crisis. Do you agree? I certainly agree that rates were held artificially low after the 2008 financial crisis. And I think that's a big part of the problem that we're facing today. If we go back to that long-term chart, I said this back in the beginning of 23, but this was unprecedented to have rates down, below or to basically 0% on the 10-year yield. And it's like pushing a beach ball under the water. That beach ball is going to pop back up, and it creates a real danger of that 10-year yield moving to the 5-6% range or higher. I think that's a real risk, and I think it's a serious, sobering risk that none of us should want, even if we're betting on, higher yields and lower bond prices. All right. But it's going to be bad news for all of us if that happens, and nobody should wish it on anyone. Dalio, since 1944, debt was used in a healthy way. Borrowing created enough income to service the debt, right? You can have debt, constructive debt's okay, but you better be able to service it. And we're kind of in a questionable range of our debt serviceability right now. Over time, more debt was taken on without sufficient income growth to support it. The situation reached its peak during two major fiscal stimulus events: COVID stimulus packages, massive government borrowing and direct payments to individuals, and post-COVID spending and wealth transfers, more government borrowing to fund various programs. This led to inflation that was entirely predictable. You can't send out trillions of dollars and expect no consequences. Thank you, Dalio. Well said. Tucker, yep. Many policymakers seemed shocked by inflation. Dalio, they shouldn't have been. It's basic economics. Exactly. This isn't just a US problem, it's a global debt problem. Europe, China, and other major economies are dealing with the same issues. And remember, debt crises don't just cause financial problems, they fuel political instability. If governments can't manage debt properly, they create internal conflict. That leads to geopolitical instability at a time when international tensions are already high. Okay. So that's really the summary of what Dalio was talking about in this interview. They fuel political instability. That goes back to the other types of cycles, right? The internal conflict cycle, the external conflict cycle, natural disaster cycles, and technology cycles. So all those are part of it. Now, not everything got captured in this initial summary by ChatGPT, but it did a pretty good job. So now I'm just going to share with you some of what I've been doing to try to better understand this problem using my own experience and ChatGPT, right? And I do think it's a good illustration of how these tools can actually, how we can use these tools, right? The tools don't answer our problems. They don't give us the answers. They help us to reason through problems and to explore solutions ourselves, okay? The computer won't give you the answer because there isn't an answer in that computational deterministic way. It's just life lived experience. How am I doing on time? All right. So I then, I wanted to get a little more detail from ChatGPT. I asked it, what was the original word count of the transcript and what is the word count in your final version? Its answer was completely wrong. Talk about hallucinations. The original transcript had approximately 233 words. No, it didn't. It had over 2,000 words. I looked at it in Microsoft Word. While the final revised version has 309 words. No, it didn't. So ChatGPT does not know how to count. Okay, forget about counting. So I went through a bunch of iterations until I finally just started giving it chunks of the transcript. I had to go through the transcript myself, break it up into chunks, and get it to clean it up. And it did. It finally did a pretty good job of that. So, I'd take a chunk here about here's what Ray said, and then I'd ask Chat to clean it up, and it did a good job. So through that, I was able to get a more detailed version of the transcript, but it took a lot of work. Okay. And I think it's a good example just of what this technology can and can't do. On the one hand, it did create a summary for me just out of the gate that was pretty good, but it missed some big things. And then to get it to do what I really wanted it to do, it took a lot of work. I'm not sure I would have really saved that much time or gotten a much better result than if I had just kind of gone through the rough transcript myself and edited it into a final document, which is basically what we did with ChatGPT here. So I'm not going to take you through all that. I'm going to get down to some of the follow-up questions I asked ChatGPT to take us through. Okay. So thanks for all that. Now I have some questions about Dalio's thesis. Can you explain how debt is money and money is debt? So yes, when Dalio says debt is money and money is debt, he's referring to how modern financial systems work under a credit-based monetary system. A credit-based monetary system. That is what we live in today. Okay, money in today's economy is mostly credit, i.e. debt. In our financial system, most of what we call money isn't physical cash, it's credit created by banks. When a bank lends money, it creates a deposit in the borrower's account. That deposit is considered money, but it's actually debt that the borrower must repay. If you take out a $10,000 loan, the bank credits your account with $10,000. That $10,000 didn't exist before. It was created through debt issuance. You now have money, but the bank holds an IOU or debt from you. Okay, so that is how our economy works today. So in this way, money is debt because most money in circulation was created through borrowing. There's a lot more detail in here. Bottom line, money is debt because most money in the system is created through loans. Debt is money because government bonds and credit instruments function as forms of money in financial markets. The risk when debt levels get too high, it becomes harder to maintain economic stability without triggering inflation, devaluation, or defaults. That's where we are today, right? This is the core of Dalio's concern. If debt becomes too unsustainable, the entire financial system faces instability, and that leads to political instability. So I said, how far back in history does our modern financial system go? When did money as debt get started? The idea of money as debt goes back much further than most people realize. While our modern financial system has evolved significantly, the core principles of credit-based money have existed for thousands of years, going back to 3000 to 500 BCE, right? There was even credit back then. Merchants and farmers borrowed grain or silver with a promise to repay after the harvest. These early forms of money were not physical, they were records of debt. Okay, so it goes through some interesting history, which is cool. And then the fully credit-based system, 1971 to present, after the US went off the gold standard, right? After 1971, all money became debt as central banks and commercial banks could expand the money supply through lending without physical backing. No physical backing, right? Today, over 90% of money exists only in digital form. And the Federal Reserve and other central banks now manage interest rates and liquidity by controlling credit flows, not gold or physical money. This is why the liquidity flows that Michael Howell was talking about in his interview with Lars von Tienen are so important in markets right now. So when did money as debt start? The concept dates back at least 5,000 years to Mesopotamian debt ledgers. Okay, sort of. The modern system where most money exists only as bank credit and government debt fully emerged after 1971 when the gold standard ended, right? That was just over 50 years ago now. And there's no anchor anymore, right? It's fully credit-based, and that's a kind of terrible power that is wielded in our world today. Dalio's concerns about excessive debt and instability are rooted in this transition. Once money is purely debt, governments and central banks have no limit on how much they can create, no limit, which can lead to devaluation, inflation, or financial crises. Tucker mentioned an 80-year cycle, which Dalio seemed to agree on. Does Dalio have a theory of an 80-year debt cycle? If so, please summarize what you know about it. Okay, so yes, Dalio does incorporate the idea of long-term economic cycles. He talks about a 75 to 100-year cycle and the short-term debt cycle of 8 to 10 years. We just saw Martin Armstrong talking about an 8.6-year cycle. You know, it's basically the business cycle. So we have this kind of long generational, 3 or 4 generations, Neil Howe, the fourth turning, and the shorter term, 8, 9-year, 10-year business cycle. I don't think that's new to any of us. I mean, this is pretty cool stuff though, right? Like some historical 80-year debt cycle examples. The American Revolution and French Revolution, US Civil War, Great Depression. Cool. Awesome. Are we at the end of the current 80-year cycle? Dalio suggests we are in the final stage of the current long-term debt cycle. All right, so there's a lot here. I want to get to some conclusions, some ideas for moving forward from here. So I'm going to skip over some of this, but I still think you can do this yourself, right? You can have these conversations with ChatGPT or others. And again, other tools. They're conversations for you to enhance your own understanding. And you don't just take its word for it. It's a process to work through to help us together better understand what's going on. These are some pictures that it found about Dalio's cycles. Actually, let me go. Yeah, here's the one that kind of showed the longer term and the shorter term cycle together, which I thought was pretty cool. All right. This was looking at the way the different cycles fit together, acts of nature, technology. But I want to get to some conclusions. I asked, what is the current federal deficit and what's the current GDP? Right, current federal deficit, $1.8 trillion. That's not the total debt. The total debt's in the 30 plus trillion dollars, right? But that's the deficit. And GDP was, that was a monthly deficit, 29.7 trillion, about 30 trillion. $1.8 divided by 29.7 is about 6.1%, but Dalio said we're currently at 7.5%. Is he wrong, or did you or I make a mistake? He's in the ballpark, right? That's fine. All right. Moving on. I started asking Trump's tariffs could be a source of government revenue, right? Yes, tariffs could be a source of revenue. Selling federal assets, land, buildings, infrastructure, that could be a source of revenue. Repricing U.S. gold reserves, we've heard of that. That could be a source of revenue. And Dalio, let's see here. How do these compare to Dalio's three levers? Three levers being like tax income, spending reduction, and keeping interest rates low, right? Tariffs, asset sales, and gold repricing could all play a role in deficit reduction. Yep. I said productivity gains could also spur growth and increase income. Is there any recent evidence of productivity gains in the U.S. economy? Yes, recent data indicates that the U.S. has experienced notable productivity gains. Got some information there. How about improved health in the U.S. population? Could that improve productivity? Yes, improved health could significantly boost productivity in several ways. Talked about that for a little bit. So now I started to get into what longer term series data could we track and analyze in order to follow some of these trends and look for indications of success or failure in achieving Dalio's goal of a 3% deficit to GDP ratio. And now it started getting pretty interesting. Fiscal and debt indicators, right? Federal budget deficit, total national debt, gave me sources of where I could find those things. Economic growth and productivity sources, inflation and interest rate environment sources, labor market and workforce health sources. Super cool. Global trade and tariffs. How to use this data to assess success or failure. And then it said, you want me to build you a dashboard? I said, yeah, I'd love that. Build me a dashboard. Can you build me a dashboard that tracks all of that? No, its first effort was pretty weak. Just gave me a list of the indicators so I could fill in the values myself. I said I wasn't too impressed. Can you get me the historical values of those data sources? I'd love a URL to the data source and a spreadsheet with as much historical data on each of these indicators as possible. So I haven't gone through all this yet, but it did start to give me some links, which is pretty cool, to look for these data sources, which I'm going to do. Try it again. Now, can you get that historical data for me and put it into a table with dates aligned? No can do, it said. But still, it's pretty good list here with some sources to follow up on. So again, I tried to get it to give me a little more help. Gave me some suggestions about how to do it, but wouldn't do it for me. But I do think this is some stuff that we could follow up on. So lastly, I I said, Dalio says that the U.S. successfully lowered the deficit by 4 to 5% of GDP between 92 and 98. Is that true? If so, what were the key drivers that helped that happen? And what are the key differences between 1992 and 1998 today? So this was really interesting. Dalio's assertion that the U.S. successfully reduced the federal budget deficit by approximately 4 to 5% of GDP between 92 and 98 is accurate. In 92, the deficit stood at 4.7% of GDP, and it decreased to 0.3% by 1997. Okay, so over 5 years, it went down about 4%, which we'd have to get down 4.5% today to do that, right? Key drivers of deficit reduction: economic growth, fiscal policies. Key differences between 92 and 98 and today, I asked about that. And I said, okay, so using Dalio's own metaphor, is the difference between 92 and 98 today that there is more debt-based plaque built up in the arteries of the US economy? Yes, using Dalio's own metaphor, the key difference between 92 and today is that there is far more debt-based plaque built up in the arteries of the US economy. In the 1990s, the economy was able to clear out some of the excess, but today the buildup is much more severe, making it harder to restore fiscal health without major disruptions. I think that is spot on. Comparing 1992 versus today using Dalio's plaque in the arteries metaphor, 92 to 98, you had 60% of GDP was the debt to GDP ratio, and now it's over 100%. The annual deficit was declining towards 0% of GDP. Now it's stuck around 6 to 7.5% of GDP, right? So this is a great list here. And lastly, wrapping up here, I said, I like the late stage heart disease analogy. If we're going to think about things through that lens, and I think that we should, then maybe we need to think about a slower recovery time than what Dalio is proposing. Dalio is proposing to do in 3 years what was done in 6 years between 92 and 98. Meanwhile, our patient is in much worse condition today than it was back in 1992. Chat says, that's a brilliant insight. Thank you. If we stick with Dalio's late stage heart disease analogy, then expecting a full recovery in just 3 years, when it took 6 years under far better conditions, might be unrealistic and too aggressive. Why a slower recovery timeline might be necessary. Okay, so that's pretty much it. A more realistic cardiac rehab approach. Instead of crash diet plus emergency surgery, we might need a bit more gradual 6 to 10 year recovery plan. Stabilize the economy while slowing debt growth. Maybe target 5% instead of 7.5%. Implement gradual spending reforms, bring deficit towards 4%. If economy remains strong, finish the job and bring deficit to 3% or below sustainably. Avoid shocking the economy into recession. Gives policymakers room to adjust growth. If growth slows or interest rates spike, maintains investor confidence without overreacting too quickly. Dalio is correct that action is needed now, but if the U.S. economy is in late stage heart disease, then an overly aggressive plan could cause more harm than good. A gradual 6 to 10 year stabilization plan might be more sustainable and politically feasible. Goes on, offers me some historical case studies. That was interesting. And key takeaways for the United States today. Economic growth. Sustainable and inclusive economic growth is crucial for increasing GDP and reducing the debt to GDP ratio. Huge. Comprehensive tax reforms and prudent spending are essential. This may involve difficult political decisions to balance the public services with fiscal responsibility. Political consensus, achieving bipartisan support. That's kind of discouraging, wouldn't you say? Is vital for implementing effective fiscal policies. Historical examples such as Canada's political consensus in the 1990s highlight the importance of unified action. Structural reforms. Addressing long-term liabilities such as entitlement programs can help manage future debt. All right. That's it. That's what I got for you today. Summing up, I think Dalio's analogy of late stage heart disease in the US economy, plaque building up in the arteries, restricting spending. We have to be realistic about where we are in the cycle. This is what a knowledge of cycles can do for us, okay? They can help us navigate our situations more realistically. And if we pretend that the cycles don't exist, if we pretend that we're not, in a big debt cycle right now, that there aren't tailwinds for higher rates that are going to require more than Trump waving a magic wand and magically getting the bond market to cooperate, that's not going to happen. We're in a serious situation, and that is what the cycles tell us. And we have to figure out how to manage that situation in the context of ongoing cycles. How can the business cycle work in a way that we can ultimately bring down our debt to GDP, bring down our annual deficit? How can the annual seasonal cycle potentially be understood to help us navigate this bad situation? And it is a bad situation. There are no winners here, okay? There are not winners and losers. We're all going to be losers if we don't figure this out together. So that's what the cycle tells us. They're bigger than us, bigger than red and blue, bigger than the US and China. And I mean, in many ways, that's the hope, right? That we can all see that we've got this big problem and that we better work together to figure out a way out of it. And we better not just stick our heads in the sand about the reality of the cycles that we're in the midst of. So I think that's it for today. Again, this is the beginning of a conversation, not the end. I haven't provided a bunch of answers. I do think that through that exercise, I was able to better understand what we're really facing right now, where we are, and also that idea of looking back at the 92 to 98 example and going, well, we were in much better shape back then, and it took 5 to 6 years to lower, the deficit by 4.5%. Maybe it's going to take 10 years now, but that's starting to get realistic. But I do think that is a common goal that we can all, row in that boat together towards and get a lot of bipartisan consensus on. And I think we really need to do that. So please do let me know your thoughts. Where am I at? 12:48. All right, let me just see here. Looking at your questions. Improve health to work longer. Yeah. And just improving health in general. I mean, my family's pretty healthy, but even in my own family, we've had issues that have been kind of chronic and debilitating and limited the full ability of what we can do. Long COVID stuff. And I think a lot of people are going through that right now. How do we get past that? If we could get past that, could that help the economy? Absolutely. The audience might like to read Sidney Homer's History of Interest Rates. I have that book somewhere. It's like a doorstop. And appreciate the recommendation, Dale. Somebody wants to tackle it, by all means. Less inflationary and better for the economy if the government did not print to borrow, but just printed without borrowing. Debt to equity coupon on current debt, then abolish government borrowing. Interesting. I'll have to think about that one a little bit more. Thank you. Mark, Dr. Smith, when asking ChatGPT questions, If it does not produce the answers you're looking for, try asking again in a couple of days. Yeah, it is, look, these tools are very powerful. I use them. I'm a big fan, but you do have to take responsibility for your own knowledge. You just got to do that. You cannot accept that these things are going to give you answers. And it's a terrible idea to think that, oh, well, it's all going to get better and better over time and they are going to give us the answers. No, that's not how it works. If we go down that path, we're not going to get the benefits out of this technology. I promise you. DR, have you heard from Jake? Yeah, so, okay. Fed does not control long end part of bond market, only the short end. Crisis in government and the debt they do not want to pay. Current. All right. Cicely Ann, thank you. I don't quite get it yet, but I'm going to look into it. Start to reduce blood pressure to avoid plaque forming clots. Blood pressure of the USA looks bad. I agree, Leanne. Trump is familiar with the process of debt to equity swap. I'm not completely unhappy that we've got a bankruptcy expert at the helm, along with Scott Bessent, who was George Soros's, currency trading right-hand man, like knows how to manage a currency crisis, knows what goes into a currency crisis. I wish we weren't at this point, but not bad skills to have for where we're at. Bruno, thank you. Let's see. Elliot, it would be outstanding. You have your ChatGPT interview available as a readable document. I'll see what I can do there. Bruno, are the American developed world consumers ready to reduce their standard of living to repay partially the debt? I think that's a great question. And, reminds me of the famous Kennedy line, right? Ask not what your country can do for you, but what you can do for your country. And I do think that people are willing to seriously consider things like that at this point, Bruno. Reasonable people are. And, I'm afraid that the reasonable people get drowned out by the algorithm-driven media nonsense of our world today. But there are a lot of reasonable people out there, more so than the psychopaths. And I do think most of us are willing to make personal sacrifices in order to have a better future for future generations. Why should consumer reduce spending? That's bad for economy. Better to grow the economy. I agree. But there's a lot of things that go into growing the economy. The biggest one is cooperation, togetherness, unity. That's the thing that I really fear the most right now. The algorithm algorithm generated conversations that we're having right now, because our media just doesn't even exist. But like I said, cycles can help us to understand the waters that we're swimming in, right? Who wouldn't want to understand the tides? If you got to get your boat out to sea, you want to understand the tides. And we're in the midst of tides in the affairs of men. Edgar Lawrence Smith. All right. Thank you, everybody. Thanks for listening. Thanks for the opportunity to think through these things and to do this together under the banner of the Foundation for the Study of Cycles. We'll keep on it, and please keep in touch. Let me know your thoughts. Post your chat, your comments. Bring other people to this channel. Ray Dalio, if you're out there listening, thank you. And we'd love to work with you and bring a knowledge of cycles to more people together. So see you next Tuesday, if not before. Thanks, everyone.